Hello, Jim here. I've been selling covered calls for many years, probably going back 15 years, primarily on dividend aristocrat type companies like Coca-Cola, Procter and Gamble, and I've been very successful with it. Now, recently, I've started trading in more momentum companies, companies that have shot through the roof like Palantir, AMD, Nvidia, and so on and so on. And what I've realized is I'm kind of clipping my wings. I'm missing some upwards potential. Today, I want to talk about that. I want to talk about the steps I'm going to take going forward, how I'm going to change the way I actually work with covered calls. And I've created what I call my filtered checklist. I'm going to share with you a little bit about that. I'll go over it and how I believe it could be a step in the right direction for avoiding major missed opportunities with some of these momentum stocks. So stay tuned. I think it's going to be well worth your while. Okay, let's jump right in. Now, I do want to take 2 seconds just to talk about what a covered call is, just for those people who might be watching who have never traded a covered call. So when you own 100 shares of stock, you can sell what's called a covered call. It's where somebody will pay you some money for the opportunity to buy your stock. And what you can do is you can pick what's called an expiration. So you could say, over the next month, I'll give someone the opportunity to buy my shares and they'll pay me at a certain amount for a certain price. So if I'll use an example of Coca-Cola, $70, you could do a covered call, say for 30 days out, and maybe go to $75, and someone might pay you $1 for the opportunity to buy those 100 shares at 75. So you're gaining some value from going from 70 to 75 and picking up another dollar in the process. And I did that on Coca-Cola and Procter and Gamble and quite a few other companies. And it works out really well for dividend paying companies or dividend aristocrats. But when you get to momentum companies, when you get to companies like Nvidia, AMD, and so on, a stock that could double in a couple of months, like I believe AMD has doubled in the last month. Nvidia might be up 30-40%. And I've had others. I've had like APP, Seagate that have doubled or tripled. I think APP might have quadrupled. And it's really hard to write covered calls on those or sell covered calls on those, mainly because it shoots through your strike price and you end up what's called in the money. And it's really hard to roll when you're very, very deep in the money. You end up having to pay quite a bit. And that's the whole reason for this video. I've kind of identified some things I'm going to look at. I'm going to potentially not trade covered calls on some stocks. Like if it's a major momentum player, maybe I won't trade a covered call on it. Or I might do what's called a vertical put credit spread, but paired with 100 shares that you own. I call it a covered call, vertical call credit spread or covered call credit spread. I'm still kind of working on the name for that. There may be a real name for it somewhere out there. But that way you might miss out if the stock shoots through the roof, because with call credit spread, you would still sell the covered call, but maybe $10 or $5 out, you would also buy the long call. So you wouldn't bring in as much money for the covered call, but you could potentially, if the stock shoots through the roof, you could sell that long call because it'll become worth more and more as that stock goes up. And you could use that, you could sell that to help you with rolling the current covered call to a higher price. And rolling is just closing your current position and opening a new one. So it would limit, the only missed opportunity would be the spread minus whatever premium that you brought in. So say it's a $5 spread. Well, it may only be $400 that you miss as that stock shoots up. So what I decided to do is to set up what I call my covered call filtered checklist. So it's a checklist that sits on top of my covered call checklist, and I'll share that with you at the very end, and then go into a little bit of detail about why I did that and how I think it might benefit people. It identifies what type of company, and maybe this type of company you should do a covered call, or you should do a call spread. And this other type of company is perfectly fine to do a normal covered call, and what kind of criteria you might want to use to make that determination. So stay till the end when I'll go into that in a little more detail. So the negative with covered calls is that hidden issue. If that stock goes up too much and you end up deep in the money, you've clipped your wings. You can only earn up to that certain point, and in some cases, it really limits it. And it's painful because if you see a stock go, double and you're stuck with a 10% return, that can be very painful in the sense of the missed opportunity. So to me, that's kind of the hidden cost. It can be even worse if you sell that covered call below the cost basis. So one of the things I always tell people to start with, and this is in my covered call checklist, is be sure you always sell the covered call above your cost basis. I'm also thinking, decide what kind of return you want when you're doing it, especially on these momentum plays. If you don't have that covered call high enough, meaning a lower delta, and you're taking less risk that it would get called away, but you bring in less premium. So that the lower the risk, the lower the premium, you don't make as much. But again, if that stock shoots through the roof, the appreciation of that stock can be so much higher than just selling covered calls on it. And then at times, if you do end up with a covered call that's way deep in the money, I try to roll them up and out, but at times it doesn't make sense to even do that. It might be a better opportunity for those shares to get called away, especially if you're in a retirement account because you don't have tax issues. If you're in a regular brokerage and there are tax issues, you just have to kind of weigh that. But maybe letting it be assigned is the best avenue because you can put that capital towards something else. And that's something I didn't do enough of. I do have a few positions that will probably get called away from me, where I literally cannot roll up. Even if I go out and look at a leap, there's no opportunity. And again, those are the same situations I was just mentioning. I think Seagate might be one that I'm in that kind of a situation. Plus, you never know when you're going to get a pullback. So you may get an opportunity to pick up that stock again and sell covered calls in a different way down the road. So you have to be careful. If you do a leap and you pay some money and you're kind of stuck again deep in the money, you've locked in what your return will be through that period of time. Now, if you do roll out and you go 6 months to a year, I'm also thinking it's really important to define what kind of return you want. So if you roll out, 6 months, but you're able to bring the strike up enough and make enough money to pay to close the current position, then look how much, what kind of return are you making on that roll? I'm trying to push for a 15 to 20% return in those situations. And it sounds easier than it is, but, look at it. Look, can you roll out 6 months or even a year? Can you get 15 to 20% return? So if you're deep in the money and say the stock's 140 and your call is 90, can you roll it up to get, maybe up to 110? You can't get all the way up, but you're still getting like a 15 or 20% return. And again, this is also part of my checklist. So, and then other times it might make more sense just to avoid a covered call completely. So, it's hard to determine when that might be, but definitely if the stock is a potential momentum stock and it's underneath your cost basis, meaning maybe those shares were assigned to you from a cash secured put or a vertical put credit spread, and your cost basis, the only way you could sell a covered call is to do it underneath your cost basis. I would say don't do anything. Let it take some time, let the stock recover. Typically that will happen after earnings, like maybe you get assigned, then they have earnings and it drops big time. You can't really sell a covered call above what you paid for it. After earnings, if a company even has modest bad earnings, they're going to drop big time. So, but what happens is they kind of inch back up. They will recover. I just believe the market is kind of I don't know, because there's so many retail investors and so many people trading now, it seems like it goes too far too quickly and then kind of recovers. So that typically is what happens. So if you avoid selling a covered call below your cost basis, take some time, let it recover, and then start selling covered calls. But be sure you sell them high enough that you're making a good enough return. Again, I like to look at 15 to 20%. So that's the main stuff I wanted to touch on. I know with my own accounts, if I hadn't clipped my wings, I believe in most of my accounts, I'm beating the S&P just by a little bit. But if I had not had some of these covered calls, then it would be quite a bit more. It might be like beating the S&P 500 by 10% or 15%. So that's what I wanted to talk about, but let's actually jump into the checklist and I'll dig a little bit deeper. And I'd like your feedback too. Let me know what you think. I do share this with my members and I've had feedback from them. So it's a work in progress. I'm trying to make it better and better. And I really want to help people with dealing with this little dilemma, especially with this crazy market. It seems like every day or at least every week we're hitting new highs. So let's next jump into the checklist. Okay, here's my covered call strategy filter, and it's decide when to sell calls and when to let great stocks run is the main emphasis. There's a note before you begin, and I make this available to all my members. I have a collection in Patreon with checklists, and then within Discord, I also have a checklist area where I put all the different checklists I have. This is my third one. I have one for covered calls, one for cash secured puts, and now this one, and I'm going to be making more down the road. So here, the checklist is a strategy or strategic filter to help you avoid capping strong upside potential or on growth stocks, momentum stocks, as I like to call them, and use it before placing any new covered call trade. The more boxes you can confidently check, the more appropriate a covered call may be for the position. So here, like step one, and you guys chime in, leave a comment if you see something that I've missed or, you want me to add something to this, leave a comment. I try to answer all my comments within 24 hours. At the worst case scenario, 48 hours. So the first step is to classify the stock or ETF. Is it growth or income intent? Is this primarily an income focused stock or ETF with slow, stable price action? Does the stock pay a dividend of 1.5% or more? I could have, the question is, should it be 1.5%? That's the number I came up. It seems like there are a lot of growth companies that pay really small dividends, but the 1.5% typically, 2% may be better, but most companies don't have the crazy price action. From what I've noticed, if they pay a dividend of about 1.5%. For ETFs, is the distribution yield at least 2% with lower volatility? Examples are XLU, VYM, JEPI, and so on and so on. Is the position not part of your long-term growth portfolio? So a few things to look at. You check them off. Then step two is check the breakout or high upside risk. Avoid capping big winners. Has the stock shown strong momentum or recent breakout potential? That could be through earnings. It could be through news or some new products that they've released, kind of like AMD with their new chips coming out. The MI350 are coming out with a lot of fanfare, and the chips next year are even higher fanfare. They're going to compete with NVIDIA, which on the high-end chips, the AI high-end chips. So would I regret being assigned if the stock surged 30% or more? Have I previously capped similar names too early? Again, APP, Palantir, NVIDIA. You can kind of look at NVIDIA and think about AMD. I think AMD long-term might do better, at least over the next 5, 6, 10 years or something compared to NVIDIA. NVIDIA is showing in their earnings that things are going to really slow down in about 2 years, where it's like picking up with AMD, because AMD is kind of answering a need, a part of the market that NVIDIA, I think, has stayed on the high end and has not released many chips in this lower end or middle tier. Do I expect a potential run up from earnings, news, or macro catalysts? So again, what's going on, what's happening with earnings? Trying to again to identify this is a momentum company that I might really want to change the way I sell covered calls on it. Step 3 is consider partial or alternative strategies. So keep upside while managing risk. So sell calls on only part of the position. So I like to do 2 contracts. If it's an inexpensive stock, I'll do 3 or 4. I've done as many as 6, like on really inexpensive stocks. But if you like to do 2 or 4, well, maybe just sell the covered calls on part of your shares. If you have 400 shares, just maybe sell covered calls on 200. So you're only capping part of it. Use a poor man's covered call, deep in the money leap for far out of the money short call. That's the key point. Because again, and I had this question today from, I believe, a subscriber. Even if you do a poor man's covered call and the stock shoots up, it's not going to protect you. Again, if you sell that covered call too cheap, it might still look like a really good return, but when a stock like Palantir, that happened to me in Palantir, my Palantir shares got called away because I just could not keep up with rolling the covered call on it. But it's something to consider. Let's see, the next one is use a protective put instead of a call to manage downside without limiting gains. So just by buying the long call, you are limiting how much you're making with the covered call, but on the upside, you can potentially do really well. I did this with AMD. I actually purchased the long call, turning it into what I call a vertical call credit spread or a covered call credit spread. And it worked out well because when AMD first shot up, that long call became worth a lot. I decided to sell it and use it towards rolling AMD way up. But I could have just let it those shares get assigned away to me and then back to me. That might have been the better way to go. Now with the fact that AMD, I believe, is above 160. And then, if the stock has strong upside potential, but you still want to generate income, consider setting up a covered call vertical spread from the beginning. So then that's key. If you don't do it from the beginning and you end up deep in the money, it becomes a lot more difficult. Buying that long call once you're deep in the money can be quite pricey, and it can be difficult to dig yourself out of that hole. So it's important to think about it on the front end, not the back end. By buying a long call above your short strike, this preserves partial upside if the stock runs. Step 4, confirm strategic fit. Long-term alignment. Is this trade part of your income bucket, not your growth bucket? Will this covered call enhance your monthly income without compromising portfolio goals? Is the opportunity cost of capping the upside low for the ticker, like Coca-Cola? It's somewhat low. Procter & Gamble, some of those dividend aristocrats, it seems like the higher the dividend, most of those companies are not going to have the momentum that you see with these growth companies. Now, the exceptions are companies like Google and Amazon and Apple and, some of those, and even Microsoft. They pay very low dividends. So that's where I think the percentage for the dividend, like 1.5%, maybe it should be 2%. Again, leave a comment if you disagree. And then step 5, final filter before you trade, know when to hold back. You can confidently say this stock is not a high upside play. The income from the call outweighs the risk of missing a large move, meaning you're above the cost basis. You've got a covered call that's giving you a nice, maybe 15% return while and you have no interest in owning the stock. The covered call aligns with your risk profile and your capital goals. and then in step 6, make the final decision. Is this an income trade or let it run? If most boxes in step 1 and step 4 are checked, it's likely a good candidate for a standard covered call. Again, it's probably a dividend aristocrat or a company that doesn't have a huge amount of momentum. There could be other ones like I like to talk about Fiverr and some of those. So it's not always going to be a dividend payer. It may just be a technology company that just doesn't have the momentum compared to some of the other big boys out there. And then if most boxes in step 2 and 3 are checked, strongly consider not selling a call and letting the position run. The next is if income is still desired, set up a covered call vertical spread at entry. By adding a long call above the short strike, this helps reduce the regret of if the stock breaks out. And that's what I was talking about before. This is my covered call vertical spread. And again, it's critical to do it at entry. Once you're already deep in the money, it's very difficult to do. And like I said, I did this with AMD and it's worked out fairly well so far. If unsure, hold off or sell a partial covered call or just a portion of the position. Now, if you are deep in the money and say you have 400 or 500 shares, one thing I suggest to a lot of members, and I've done it myself, I may sell 100 shares and then pay off a bunch of the covered calls because I want to keep owning those positions. Or sometimes it's not even 100 shares, it may be 50, and then I can start doing cash secured puts or vertical put credit spreads to build up to, the number of shares I had before. And then the final one, this strategy filter is designed to protect high upside positions with premature capping or from premature capping. Covered calls are ideal for income producing stocks. For growth plays, consider verticals or flexible structures that preserve your best upside, again, while still generating income. Now, there are other strategies people will do. Sometimes people will sell a cash secured put while they're selling the covered call to bring in more income. If I've missed something, again, please leave a comment. And I plan to probably share this with my community in the next day or two. The previous version is already out there, and I do have members adding comments and leaving their own feedback. So, and if you're interested in my membership, it continues to grow. A lot of members are sharing trades just today. I actually did a trade that one of the members did in my Discord. They actually traded Eat, which is the parent company of Chili's, one of my favorite places to eat. So I've traded in Eat before. But it turned out to be a really good trade. So take a look. It may be worth your while. What's different from me compared to a lot of other people, if you want some one-on-one with me, you talk to me. You don't talk to someone else before me. If you want to try the membership, you don't have to jump through hurdles. You don't have to have a phone call. You can literally jump on and try it. I've had members come and go. I've had members upgrade, downgrade, so take a look. It may be well worth your while. So thank you again for taking the time to listen and watch. And as always, I really appreciate, all your comments. So please leave a comment or two. And I hope you have a wonderful afternoon.